Trading opportunities can come over time or within a day. No matter what your time horizon is, if you're looking to day trade in a margin account, then it's good to know the rules. First, what's a day trade? A day trade is defined as a position that is opened and closed within the same trading day. So what are the rules? Margin accounts and margin-enabled IRAs with an account value below $25,000 are limited to 3-day trades in a rolling 5-business day period. Let's take a look at a week to get a better picture of this. Here we have a $10,000 account. On Monday, we decide to buy 100 shares of ABC at the open for $50. Later that day, ABC rallies to $55 and you decide to sell the 100 shares. By selling those shares, you would reach your first day trade. Tuesday comes along and you decide to sell a short call spread on XYZ for $1 in the morning. 10 minutes later, XYZ gaps up and your short call spread is now worth $1.50. You decide to wave the white flag and buy it back for $1.50, resulting in a $50 loss and your second day trade. Later that day, you decide to sell a put on XYZ for $3. XYZ continues to rally that day and your put is now valued at $1. You decide to cover before the market close, resulting in a $200 profit. This is where our day trading journey must end for now because we've hit our limit. Since you are limited to 3 day trades in a rolling 5-business day period, your first day trade would fall off 5 business days later. The second and third day trade would come off the next day. If you're wondering what happens if you did more than 3 day trades, then let's rewind back on our trading week to Wednesday. You decide to buy a $20 call on ABC for $2 in the morning. An hour later, ABC gaps up and you close out of your call by selling it for $4. Since the account performed more than 3 day trades in a rolling 5 business day period, the account would be flagged as a pattern day trader or PDT. And since the account is valued at less than $25,000, you will receive a PDT Equity Maintenance Margin Call, or EM call, and the account will be set to closing only. Regulatory rules state that traders who perform more than 3 day trades in a rolling 5 business day period are flagged as pattern day traders. Once flagged, you must maintain an account value of at least $25,000 to continue to day trade without restriction.
But if it is your first time getting an equity maintenance call from being flagged a pattern day trader, and you are unable to bring your account value above $25,000, then you are eligible for a one-time reset for the lifetime of your account. That means that if you happen to slip into another equity maintenance call a week later, for example, then you will not be eligible for a PDT reset for the foreseeable future. The only way to meet this call besides submitting a PDT reset is to bring your account balance to $25,000 or above.
Reset requests occur overnight and the account will be restored the next trading day. We get it, day trades happen, but if you continue to day trade, then there are rules to follow or qualifications to meet to be a day trader.